Trade negotiations between Prime Minister Mark Carney and U.S. President Donald Trump left many investors disappointed as Canada remains the only G7 country without a trade deal with the United States. Our next guest says this puts Canada in a precarious position and suggests the country may need to move away from the trilateral CUSMA agreement and instead deepen its trade ties with Mexico. Let's hear more from Jack Manley, global market strategist at JP Morgan Asset Management. It's good to have you join us. Thanks for taking the time.
Oh, of course. It's very nice to be here. Thank you.
So Prime Minister Mark Carney announced yesterday that he will not be imposing retaliatory tariffs on the U.S. now. What do you make of this latest approach?
I think it is a sign that there is a whole lot of willingness in Ottawa to find a way to get to a negotiation point where we can at least start to see something that resembles a trade deal. Now, I know there are a lot of kind of caveats there that build up into that point, but the relationship between the United States and Canada from an economic perspective is an enormously important one. And getting this thing right is extremely critical for Carney's government right now. The fact that Carney has decided to not impose retaliatory tariffs, I think is meant to be interpreted as a gesture of goodwill to get this ball rolling forward to hopefully sort of close that gap and be the last G7 country to get a comprehensive deal on the table.
We'll have to see whether that works. I mean, it seems kind of day to day in terms of an approach with Donald Trump. But in the meantime, a lot of people talking about this idea of just having more of a bilateral agreement between Canada and Mexico, kind of lessening our dependence on the U.S. What realistic steps can the government take to do that, to lessen Canada's dependence on the U.S.?
Well, I think, first of all, it is important to point out it's going to be difficult for Canada to do that, no matter what the sort of government impulse might look like. 25% of Canada's GDP is derived from exports, so a very large portion of Canada's economy. 75% of those exports are destined for the United States. So, we could see that number shaved down by 5 percentage points, 10 percentage points. You are still talking about the overwhelming majority of exports ultimately landing in the U.S. That means that totally disentangling Canada from America is functionally impossible. One of the things that is somewhat encouraging, though, to your point, is that Canada may have more avenues to pursue with bilateral trade between itself and Mexico. And U.S. policy may actually help to accelerate that process. We know the U.S. president believes that there needs to be a fundamental reworking of CUSMA at the moment, at least. We'll see, to your point, what tomorrow may look like or what next month may look like. And we anticipate that we may be moving away from the traditional trilateral agreement, Canada, the United States, and Mexico, to more bilateral agreements between the U.S. and Canada, the U.S. and Mexico. And in that situation, it makes it a little bit easier for Canada to step in and be that trading partner of choice for the neighbors south of America. So we'll see what happens, but that it could be an interesting development in the next couple of years.
Yeah, I take your point. We can't really diversify away from the U.S. completely. Okay, let's shift gears a little bit and talk about Canada's unemployment rate. It continues to be a bit of a concern, remaining steady at 7.1%. In your view, will labor continue to be an issue in the near term, or do you think that could resolve?
Labor is a big problem in Canada. It's been a problem for a while, and I don't see any sort of near-term resolution to this issue. There is very clearly a lot of negative sentiment in the country right now, and that negative sentiment is going to be weighing on businesses and their willingness to go out and hire. And we saw a very strong jobs report recently, but that strong jobs report was very much an anomaly. We are looking at a negative number on the 3-month moving average payroll figure. The bulk of payroll gains have been for part-time employment. The bulk of payroll gains have been on the public sector rather than the private sector. And this is an economy that very clearly needs less labor than it did in the past. And I think a lot of policy changes in Washington are helping to exacerbate that problem. Further complicating things, though, is the supply side of the equation. And immigration has been an enormous driver of labor supply in Canada. In the United States, that's also true. But in the United States, we are seeing some pretty aggressive, comprehensive changes to immigration policy. You are not seeing something quite to that extent in Canada. And for that reason, you have an unemployment rate that has been structurally several hundred basis points higher than what you see down south in America. America. So when you have an overabundance of supply and labor and a shrinking demand for labor, the net result of that, it's just math, is going to be a higher unemployment rate. And like I said, I don't think there's anything in place that will change that anytime soon.
Not even the next announcement from the Bank of Canada that couldn't help to kind of alleviate some of these current concerns or worries?
To Macklem's credit, to the bank's credit, they are extremely nimble, and I think they've proven themselves to be probably the most data-dependent central bank out there. I have nothing but respect for the way that those policymakers have managed a very precarious situation. But 25 basis points is not going to fix everything. 50 basis points is not going to fix everything. I think the linchpin, unfortunately, is some sort of trade agreement. And what we've been saying really from the beginning, and this still rings true right now, is that it's not about the quality of any potential deal that may be rolling down the pipeline. It is about the existence of any deal at all. Businesses just need to know what the rules of engagement are going to be so they can plan for them, they can plan around them. We're still in no man's land right now, and that makes any sort of long-term strategic planning much, much more difficult. Monetary policy is not going to fix that quickly.
Okay, so interesting. It's really good to get your insight. Thanks so much for joining us.
It was a pleasure. Thank you very much.
Thank you. That's Jack Manley, global market strategist at JP Morgan Asset Management.